Hello guys, this is Rajkumar. In the previous class we have studied what is money multiplier, how the money will get multiplied into many times than the original money through the banks, and what is M0, M1, M2, M3, M4, and what is inflations. All these things we have studied with examples. Now in this class we will study what are the tools available with the RBI to control the inflation, that is CRR and SLR and OMO, the open market operations, and market stabilization scheme. All these things we will study one by one. Before going into what is CRR, SLR, how it controls, let us see what is NDTL. NDTL means net demand and time liability. So to any bank, the time liability is FD, that is fixed asset, fixed deposit, cash certificate, recurring deposit, staff securities deposit. All these things are time liability to a bank, because it should be fixed deposit means the amount will be fixed with the bank for some period of time, after which it has to give, along with interest, it has to return back to the public. These are time liability because the deposited person cannot come in between, and he cannot break the FD legally, but he can do with penalty. Bank will apply some penalty and he will break the FD and he will give to the public. But legally bank is not bound to give that break the FD and give to the public. So these are time liabilities. Public cannot demand it as and when it requires. So fixed deposit, cash certificates, recurring deposit, staff security deposit, all these things are time liabilities. Legally it is not bound to give before maturity to the public. And latest is in 2015 government brought one unbreakable FD, because it is unbreakable. Even when you want it, even with penalty, it cannot be broken. So these unbreakable FDs should normally give more interest rate than the normal FD. So what is demand liability? Demand liability we have already seen in the previous class, where the public can come at any time and demand their money back from the bank. These we have seen current account, saving account, demand draft is also a demand deposit. Overdue balance in the FD. Overdue balance in the FD means FD will get matured, and after that 1 or 2 months after the maturity of the FD, it will become overdue. It has to be paid to the public. So it will be demand. It will be paid on demand. Unclaimed deposits, any who have not claimed it, or who forgotten that they have deposited money in the bank, all these things are demand liability of a bank. And other liabilities like interest accrued on deposit. I have told that FD they cannot break within some time. So those interest accrued on those demand deposit or fixed deposit, that will be called as other liability. And unpaid dividends, bank will make some profits and it has to pay dividend to its investors. So all these things, gold borrowed, all these things are demand other liability of a bank. So we have seen time liability, demand liability, and other liability of a bank. Now let us see, as I told, liability, demand liability and time liability. Let us say public has deposited 70 crore rupees in a bank in this week, and today is Friday. Let us say today is Friday, and over the last 14 days public has deposited 70 rupees as demand liability, and again public has withdrawn 20 crore rupees from the demand liability. So net available with the bank on this Friday is equal to 70 minus 20, that is equal to 50 crore rupees. This is the demand liability. And now time liability. Let us say today is Friday, and time liability, public has deposited 60 crore time liability and withdrawn before maturity. They might have broken it with penalty, all those things. For 10 crores they have withdrawn. Now remaining is 50 crores. So total demand plus time liability is equal to 100 crores in this case. So net demand and time liability on this day, that is Friday, is equal to 100 rupees. As we have seen previous class, when CRR increases, that is when cash reserve ratio increases, banks will have lesser money to lend to the public, and hence the money multiplier will decrease. And also we have seen when CRR will decrease, then the money left with the bank will increase and the money multiplier will automatically increase. We have seen time FD, RD, demand deposit, or CASA and DD. So net NDTL is 100 crore. Now bank has to maintain 4% CRR. It means whatever the amount in the NDTL, 4% of that NDTL it should maintain with the RBI. This cash should be maintained as it is. It cannot purchase land, it cannot purchase gold, it cannot purchase government securities. It has to maintain all the cash, it has to maintain as it is. That percentage is 4% in this case. So when it maintains 4% of the net NDTL as a cash, it won't earn any profit, any interest, any dividend. So bank will be in loss. From where this for RBI wants to control inflation, that's why it tells the banks to maintain this 4% CRR with the RBI. But why bank has to maintain? Because it is written in the RBI Act 1934, where for scheduled banks it is written that banks has to maintain CRR as per RBI Act 1934, and for non-scheduled banks it is written in the Banking Regulation Act 1949, where it is mentioned that these banks has to maintain CRR as per RBI. Now this 4% of the amount is cash. As I told, it cannot invest anywhere. Now SLR means statutory liquidity ratio, where it has to be maintained with the RBI. It can be a cash, it can purchase the gold, it can purchase the RBI approved government securities. RBI approved government securities can be government securities, treasury bills, PSU, that is debentures and all. So again, from where this RBI can tell that bank has to maintain this percent of SLR, then it is mentioned in the Banking Regulation Act 1949 as per section 24(2)(a). Now today is Friday, as I told, net NDTL is 100 crore and it has to maintain 4 crore CRR and 20.5 crore SLR. Again it will lag one fortnight, that is today is Friday, next Friday, and again next Friday, again it will calculate the net NDTL, and based on that Friday's net NDTL, bank has to maintain CRR and SLR. So there is a lag of one fortnight, that is 14 days to maintain NDTL. So today's Friday, Monday it has to maintain same NDTL, like that is the no, it has to maintain at least 90% daily. It has to maintain 90% of the CRR SLR of that Friday till next 14 days. So we have seen when bankers public deposit money with the bank, it has to pay the interest, and that money bank will rotate in the loans, and it will ask for higher interest to make their margin profit margin. Previously, at the time of Indira Gandhi and Rajiv Gandhi era, before 1991, the CRR and SLR used to be very high. CRR 15%, SLR 38%. Now total 53% of money, whatever it has taken from the depositors, 53% of that NDTL should be maintained with RBI previously. Because of this, the bank is having lesser amount to lend, and it has to pay the interest to the depositors also. So the spread of the bank used to be very high. So the interest rate of the loans used to be very high. When the rate of interest for the loans is very high, then industrialists won't borrow the money from the banks because of high interest, and the industrials won't grow, they won't expand. If they won't expand, then profitability of that industry will decrease, and it won't pay the taxes, and when it won't expand, the employment problem will increase. When employment problems increases, then company will throw the employees out of the industry. See here I told, when cost of credit loans are higher, business expansion will decrease, and when business expansion will decrease, exports will decrease, job creation will decrease, tax collection will decrease. When tax collection is decreased, the government will borrow money from the foreign, then fiscal deficit will increase, and current account deficit will increase. So there will be many problems if that interest rate of the loans will increase. So in 1991, Narasimha committee was formed to tackle these problems. So Narasimhan committee, before he suggested to reduce the CRR and SLR. So before Narasimhan committee, CRR and SLR used to be very high, and after Narasimhan committee it became very low. So lending rates will decrease. So CRR and SLR, who has to maintain this with the RBI? CRR and SLR should be maintained by the banks and all the deposit accepting banks, except this primary agriculture cooperative society, up to the level of DCC bank, district central cooperative bank, and all the commercial banks should maintain CRR. And NBFC, when we see the NBFC, all the deposit accepting NBFCs should maintain CRR and SLR. So how RBI uses this policy, that is CRR and SLR, to combat with the inflation? In the previous class we have seen, to fight against the inflation we have to decrease the money supply in the market. To decrease money supply, what we have to do is we have to make the banks to deposit more money with the RBI, so that the money supply in the market will be lesser. In this case we have to tell the banks to RBI has to tell that banks has to maintain more CRR and SLR. So when CRR and SLR rate increases, then the money supply in the market will decrease, and it can fight against the inflation. To fight against inflation, tight money policy, dear money policy, money supply should be increased, and CRR SLR should increase, so that money left with the bank will be lesser, and bank charges higher rate of interest, and people will borrow less money because it's higher rate of interest. So money supply will automatically get controlled. And to fight deflation, opposite of what inflation done, to fight deflation, the money supply in the market should increase. To increase the money supply in the market, RBI has to reduce the CRR and SLR, so that money with the banks left will be more, and it can lend more to the public, and the money supply increases in the market. Now we will see what is OMO and MSS. OMO is open market operations, and MSS is market stabilization scheme. Before going into that, we have to know what basics about financial market, how it works. Whenever government wants money, government or any company wants money for short time, that is less than 1 year of time, then it has to approve the money market, where in money market treasury bill will be there. Government issues treasury bill, cash management bills, and any other private firms, they will increase commercial paper or promissory note. Any private or PSU firms, they will increase commercial paper, promissory notes to the public, and they borrow money from the public. When the term of that borrowing is less than 1 year, and it has to approach the money market. When these government or firms want the money for longer period of time, more than 1 year, then it has to approach the capital market. If it is first time borrowing the money from the public, then government issues government security, sovereign bonds, and firms issue initial public offerings, share, bond, debentures, like that. It issues the IPO, it issues the share to the public, and it borrows the money from the public for long period of time. It has to approach the primary market when it is borrowing for the first time, and when follow-on public offering is there, then it has to approach the secondary market. And when we brought these government securities, share, bonds from the primary market, and if we want to get out of that before maturity, then we will be selling them to some other person in the secondary market, where our stock market will come into picture. It is regulated by the stock market, will be regulated by the SEBI. Now in this OMO or in government securities, how it works is, government, as I told in the previous chapter also, government issues government securities, saying that we will issue these securities, and you give us the money. In the government securities it will be mentioned, you provide us this much money, we will give back to you with interest. So these are called government securities. Government wanted money, so it is not having any money with it, because RBI prints the money. So whenever government wants money for the development of the country, then it gives the government securities to the public or RBI, where it will be mentioned that government want this much money, and we will return back with interest after this much period of time. So these government issues government securities to RBI or any persons, then it borrows the money. In this case, RBI will, as a debt manager, public debt manager, it do the auctions of the government securities. And in, for example, in this case, this person has got 10 crore government securities, and this SBI has got 20 crore government. Remaining 70 crore rupees RBI will take, and it will print the money. Or if it is having the money, it will give to the government, or if it is not having, then it will print the money and give to the government. In this case, government wanted 100 crore rupees from the borrowing by issuing these government securities. So in that 100 crore, 10 crore was brought by him, and 20 crore was brought by that bank, and 70 crore by the RBI. So now government gets the money. Now, how this RBI uses this open market operation, how it uses these government securities to control the inflation. Inflation means, we know inflation means money with the public, money in the circulation is more. So to get that money from the market, what RBI has to do with the open market operation is, this money should go to RBI. Then the RBI purpose of fighting the inflation with open market operation will serve. So in this open market operation, this RBI will give government securities to the bank, and bank will give money to the RBI. So money supply in the market will decrease. Now the question is, why these banks want to take government securities? If it is having cash with hand, it can lend more to the public, and it can earn more money. No? Why banks want to take these government securities? Bank has to take these government securities to control inflation. And the thing is, whenever depositors deposit money to the bank, it has to give the interest to the depositor. So they don't want any money idle with lying with their bank. So whenever such schemes comes to take government securities, banks will take the government securities, and money supply in the market will decrease. This method is called open market operation. This tool of the RBI, where it sells the government securities to the banks, and it takes the money out of the banks, out of the market. Then this method is called open market operation. Now I told why banks should bother to take these OMO. Idle money, they don't want to sit any money to sit idle. So they will take government securities from the RBI, and RBI fights against the inflation. Now we will see, to fight the inflation, as I told, it should follow the dear money policy. Money supply in the market should decrease. CRR and SLR should increase, so that money supply will be decreased. OMO, what OMO? In open market operation, RBI should sell the government securities and take the money from the banks. So to combat the inflation, RBI should sell the government security, and to combat the deflation, RBI should buy the government securities from the bank, and opposite it can give the money to the banks, and money supply will increase. Now after 1 year, the government previously told it wanted to take 100 crore rupees at 10% for 1 year. Now after 1 year, what the situation will be? After 1 year, all these persons will get 10%. Government gives money to all this person. This person will get 10% of 10 crore, that is 11 crore. It will become 22 crore, and here RBI will get 77 crores. Now the money supply in the market will increase. Now money supply in the market has increased, and RBI want to control the inflation. So again, it has to give the government securities to the banks, but RBI is not having any government securities with it. And these government also don't want any further borrowing, and it don't want to print any government securities. So in this case, what will happen? This actually happened in 2003, where the dollar exchange rate was very volatile, and so RBI bought all the dollars from the market. Opposite, it given the money to the market, and money supply in the market has increased. To get that money supply back to the RBI, RBI issued whatever government securities it was having, it issued the government securities and taken the money from the market. But still, money supply in the market was very high, and government don't wanted to give and take any borrowings through the government securities. So what RBI can do in this case? So in 2004 an MOU is signed with the government, where government told that it can issue government securities on its behalf and to fight against the inflation. So in that MOU, up to 364 treasury bills, in that MOU it was mentioned that these were the conditions: up to 364 treasury bills should be issued, and up to 90 days maturities cash management bills should be issued, and up to 2 years maturity government securities should be issued, and maximum ceiling to give government securities, print government securities on government behalf is 30,000 crore rupees. Using these 30,000 crore rupees government securities, it can fight against the inflation. This was as per MOU. Now, how treasury bills or cash management bills work is, for example, I have given an hypothetical situation where the t-shirt has printed price of 110. If I sell with a discount of 10 rupees and repurchase it at printed price after 364, what is the profit percentage? It means I will give actual price of the t-shirt is 110 rupees. Now I will give you at 100 rupees, and after 1 year I will take that t-shirt at 110 rupees. So what will be my profit? Interest that I have got profit with 110 rupees. I have got profit, and 110 minus what is my cost price is 100. Then my investment is 100. So 10 by 100 is 10%. In 364 days I got 10% interest. Same thing will applicable to treasury bill and cash management bill, where RBI will sell it with the discounted price, and it will take with the face value. So for example, if RBI sells 100 rupees with a 7 rupees discount, then repurchased it with face value, then what will be interest rate calculated? So it has taken with 7 rupees discount value, it means 93 rupees it has given, and profit is 100 minus 93, that is 7 rupees by 93 is investment, so 7.5% interest it has paid. Same thing it applicable. Market stabilization scheme, treasury bill, cash management bill are sold at discount and repurchased at the face value after maturity. So these MSS is market stabilization scheme, where RBI is not having any further government securities. It can print on behalf of the government up to 30,000 crore, and it can fight against the inflation. That scheme is called market stabilization scheme. So here bank was having 22 crore rupees, and that public was having 11 crore rupees. To take that money from the market, RBI will give the market stabilization scheme securities to the bank, and it will take the money from the banks. So it fights against the inflation. During demonetization, as the money in the banks, money deposits with the bank increased, and again the taking out of the money by the public was sealed to some extent. Only 15,000 you have to take in this week, 20,000 you have to take, like that. There was ceiling to withdraw the money, but deposit was heavy. So to absorb that money from the market, government has given exception to issue not just 30,000 crore rupees. It has given permission to issue MSS, market stabilization scheme government securities, up to 6 lakh crore rupees. These things as I told, treasury bills were up to 364 days, and cash management bills are maturity period is up to 90 days. This, as I told, both open market operations and market stabilization scheme, in both these cases, RBI is issuing the government securities to the banks, and it is withdrawing money from the market. So what is the difference? Actual difference is OMO is part of borrowing from the government. What is the purpose of this OMO? OMO is mainly used to not only take money out of the market, and it is also used to supply money into the market, and that means OMO can be brought and sold also. The purpose of OMO is we can buy the government securities, OMO government securities from the banks, and we can increase the money supply also. But for what purpose MSS is used is mainly it was not having any government securities to take the money out of the market. So the purpose of the MSS is mainly to reduce the liquidity in the market, and OMO is as a part of borrowing program of the government. Government wanted more money for the development of the country, so it given government securities, so it is as a part of borrowing program, whereas MSS was not like that. It was only to suck the money out of the market. Because here in this case government don't want to give any government securities, but still RBI wanted to control the inflation, so RBI has printed on behalf of government. This is not for the purpose of development of the country and all. Now the thing is, this after some time, MSS, those who have brought the MSS, they will get the interest. Who will pay the interest? Government has to pay the interest to the MSS borrowed people, not RBI. So why government has to pay the RBI, has to pay the interest to the public, means to control the inflation, to help the RBI in controlling the inflations, government can take this risk and it can pay the interest to the public. Government gets many profits from the RBI. It issues repo loans and all. From those, it gets huge amount of profit from the RBI, and so to help the RBI in inflation, government can take this much risk to pay the interest. So how RBI uses these monetary tools, OMO and MSS, to fight against inflation and deflation? To fight against inflation, the RBI has to sell the open market operations to the banks, and it can take the money from the banks. So to fight inflation, it has to sell, and to fight against deflation, it has to buy. And MSS scheme is to fight against inflation, it has to sell, and to fight against deflation, because MSS are mainly used to combat, to fight against inflation, not against deflation. The main purpose of MSS is to fight against inflation.